All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and start with the challenge here. And we have a couple easy decisions to make here. We have Intel this morning, which is trading at $50, right? Well, our stop level, stock exit level is 50.43, so we're below that stock exit level, and so I'm going to take off the position here on Intel, and so let me come out and do that here. All right. And let's see, spread. Yeah, spread's nothing too major there. So I'm just going to do a market order and out of Intel here for $1.12. Okay, $1.12. So out of Intel as it has broken the stop level. We'll close this here at $1.12. All right. That alert is out. And then Home Depot, it is past its red date. And the option, unfortunately, this morning has dipped into the red as the stock has sold off sharply this morning, along with everything else. As of yesterday afternoon, it was slightly green, but it has definitely dipped off here. So going to pull that here out at 430 here on Home Depot. All right, so both of these, very easy decisions to make. Not fun decisions. Not definitely never fun taking a loss. But am out of both Home Depot now and Intel. Where they sit. Okay, and those alerts should be out. Let me double check here. All right, I'm getting a thumbs up, so good deal. So let's come back to the spreadsheet and let's fill this in. Trade exit close date here 10/2, 10/2 p.m. AM, 10/2 a.m. on both of these. And the exit price here on Intel was $1.12, and on Home Depot was $4.30. All right. So this is a bit more of a loss than what I'd want to see on two trades. Given what the market's done, they've held up okay. This is something where had we chosen, a little bit more of an aggressive option, it would have been a lot more painful. But two trades, average loss of 500 on each of them. For the cash in, that's a little more than I wanted to see, but leaves the challenge value just over $2,000. So how do we go from here? Well, very, very easy, right? When we dip to the 2,000 level, I simply put 1,000 on each new trade until we get back up over the 3,000 level, and so that's what will happen here as we go forward. So the next signal, I'll put 1,000 on it. Signal after that, put 1,000 on it, and run them the exact same way and go forward from there. Never nice to get off to a rough start, but hey, some of the best challenges have gotten off to rough starts and made monster comebacks. But we'll see how things play out. It's very clear. We got whipsawed, very hard with the action that we saw on on Thursday last week, even Friday and Monday. Whipsawed pretty hard, where, here we go with that ISM data and, flush. And then last night, we get this idea or this, threat out of Great Britain on Brexit and a hard Brexit and all of that, helped to kind of chirp on up. It did nothing to calm any fears that are out there. Only has intensified those those fears, and we see the market continuing to sell off today. We never really saw any kind of bottoming volume yesterday. This morning, I've been watching. We've seen higher volumes this morning, but no real bottoming volume coming into the market here as of yet. When we look at kind of what's leading, what's lagging, it's an ugly mix. Tech is definitely taking it on the chin here this morning. We're not seeing a huge buy up of bonds or of gold, but we are seeing the tech exodus here today, and a lot of stocks, growth type of stocks here, really taking it on the chin, and then healthcare. Healthcare is lagging here today in a pretty sizable way. Here's the XLV, and you can see this kind of breaking down into its August lows here with the market. If we come in and look at the scans, let me pull them up here. Of crossovers, you'd think on a day like today, there's not going to be a lot of upside crossovers, but J&J has an upside crossover with its news gap up here this morning. That said, it's nowhere close to a signal here. This is one that had a 3-7 crossover right back here on this date, and it was one of the first ones I showed to kind of say, look, you know what? Yes, it has everything you want to see, but the magnitude of move is just so strong that, it tends to snap on back. We have seen it snap back very hard, and it's kind of in that same position right now where, it has an upside 3-7 crossover, but that snapback element, pretty severe there. So if we come into the downside crossovers, we saw quite a few yesterday, and we are seeing a ton this morning. Bristol Myers, Chipotle, Dollar General, Home Depot, IBM, Coke, Altria, Oracle, Procter & Gamble, AT&T, Vulcan, Walgreens, Walmart, U.S. Steel. I mean, just, 14 here in the morning. That is a lot. What's really interesting is it's consumer, on the discretionary side, but then we have 5 consumer staple stocks on this list. And you think about that and you go, okay, market's down big over the last 2 days. We tend to see staples hold up pretty well. Well, staples are getting sold here. We are seeing, a very kind of broad-based sell action, come into the market. And, we've seen the market vibe turn bearish here. And that is is this going to be a precursor to another snapback? Are we going to see more selling action come in? We'll see. The market vibe does suggest we'll see a little more selling action. But as they sit, none of these are signals here just yet. But we could see some of these materialize into bearish signals before the close of the market today. Oracle could easily turn into that kind of bearish signal. Things like AT&T, not really a good shot of turning bearish here. Though I do think T puts are a very nice proposition right here. We saw the activist investor element. We talked about it on that day that, you get an initial pop, then you get kind of a bleed, on lower, and then a sell-off back to where it was before the activist investors started buying up. So, to see this bleed back to 35 is kind of what I expect to see. But we haven't seen, many downside 3-7 crossovers in a Walmart, but, even some of these top stocks, getting hit here over the last, it's been about 24 hours of sell here in the market so far. All right. So challenge in all cash, waiting on the next signal. We'll run with $1,000 into each new trade here till we grind back to the 3,000 level. And then at the 3,000 level, we'll go back to the, about 1,200 to 1,400 in each trade, until we get our first double and then go from there. All right. So never fun to take any losses, but, hopefully through it, you kind of see how the challenge works in terms of the time stop that we saw with Home Depot, the price stop that we saw with Intel, and how that works, and kind of the simplicity of that there, and it's how profit taking works as well, and hopefully we'll have quite a few of those to go forward here. All right. Okay. Before I hop off, did want to go take a look at Ford here. Ford had some same-store sales or vehicle sales numbers here this morning, and they were slightly better than expected, but stock selling off and selling off, pretty strongly here. This is a stock we've talked about several times over the years, and we've talked about it in terms of the dividend. It was something we talked about back here at the end of 2018. Just getting into this price level that is very compelling. From a value type of standpoint here. And when we look at Ford, right, we look at Ford, and I'm just talking from an investment standpoint, not a trade standpoint. But if we look at Ford, it's one where, we just come into some of the data, right, and we look at something like the dividend yield here on it. The dividend yield is 7% on Ford. That's a monster dividend yield. Where else are you going to get 7% dividend, right? But one of the concerns with Ford is that dividend safe, right? It's one thing to have a 7% dividend, but if you go buy the shares and they pull the proverbial rug out from under the dividend there, right? Now you're sitting there with a stock that's going to go down sharply on the dividend cut, and you're sitting with a stock that isn't going to make the money back on the dividends. So now you're just kind of left in a really sour position. So being a buyer of a stock that's a high dividend and has that dividend risk, it is no fun at all, right? It is absolutely no fun at all. And if we go and we look at Ford, right, and we look at it fundamentally, and we just come in and look at the revenue on Ford over the last years. I mean, Ford revenue has been growing, and maybe growing isn't the right word because it's been a snail's pace, but it has been growing over the last 10 years and stabilized here over the last 2 years, right? Just nothing too fantastic, nothing really to write home about. You can see that as the sales growth has diminished, the price of the stock has fallen, right? When it had more material sales growth, the price of the stock, did a lot better here. So, the revenue's stable. We're not seeing huge revenue contraction, but, it is one where there's not a lot of growth to get excited about. If we look at just the earnings of the company, right? So just the normalized earnings per share on Ford, you can see the earnings per share, they just keep going down, right? So the revenues are stable, but the earnings are shrinking, right? And if you're looking to buy this stock and you're looking at the dividend or wondering about the dividend, you don't want to see shrinking earnings. That's never any fun because, less money into the company or less earnings on their bottom line, does bring a higher risk of a dividend cut. If we look at the stock relative, price to free cash flow, okay, it's getting pretty low here, but it is a company that does have plenty of free cash flow. You can see it's about $8 billion here, a little over $8 billion, almost $9 billion. It's fallen from the $13 billion levels that it was seeing in 2016. But, you take a look at a company, and the first thing that I say when there's a dividend scare is, wait a minute, the market environment is tremendously different right now. What's the cost for a company to go out and borrow money, right? It's cheap. Money is cheap. It's easy to access. It's just one of those where, is Ford going to cut their dividend or are they going to go borrow money, right? Are they going to cut their dividend or borrow money? And naturally, we think they're going to go borrow money, right? That's that's kind of the more logical step. It's very inexpensive. It's something you could keep your shareholders happy. Yeah, it adds to your debt ratios, but when debt is this cheap, and it's not like it's going to be a huge noose around the company's neck, at least for most companies. And that's kind of how I've looked at Ford and kind of how we talked about Ford even last year. But there's this ratio out there that dividend investors look at, and it's called a payout ratio. And this is a ratio that you probably don't run into very much unless you're really into dividend type of things. But it's the proportion of earnings that are paid out as dividends to shareholders. When this number, excuse me for 20 seconds here. My apologies, a little tickle in the throat. But when this dividend payout ratio is over 100%, that means that the company is having to pay all of their earnings as dividends. So they're not really able to reinvest in the company, and it's an area where investors start to get nervous, right? They get nervous because, is that sustainable? Right now, Ford's payout ratio is 110%. Can they sustain that? No, not without getting into debt, not without growing their earnings, right? So it's an area that makes investors very wary, makes them say, you know what, I may need to kind of back away from this. And when we saw Ford's payout ratio in 2015 go above 100%, that's kind of when we saw Ford stock, top. And Ford just really hasn't recovered since its payout ratio went over 100%. Now, its payout ratio came back down into the 40% area, 50% area. And when we talked about Ford, last year, the payout ratio was only in the 60% range, right? So it wasn't that big of a dividend concern. But now we're up in the 110% range. You compare that to a company like an Apple. Right? Their dividend payout ratio is 25%. Okay, not a big deal. General Motors, right? Competitive with Ford, their payout ratio is 25%. Okay. No, that's not too bad. Now, GM did have a little blip in the radar with their earnings, so it made their payout ratio, spike there. Excuse me. Again, my apologies. But then you come into a dividend stock, right? We've talked about AT&T over and over and over about this dividend, this juicy dividend here. Their payout ratio is 84%. It's on the high side, right? It's most certainly on the high side, but it's not over 100%. But I show AT&T because AT&T has gone over 100% several times. Going over 100% doesn't mean that, okay, the dividend's going to get cut. It doesn't mean that it has to get cut. Companies will do whatever they can to, try to maintain that dividend. And a lot of times we will see this AT&T scenario. This is what I expect to play out with Ford, right? Is just, okay, we're over that 100% area. It'll come back down. They're not going to have to cut. But you take a look at McDonald's. Their payout ratio, got really high. So what do? They start to borrow money to pay dividends, kind of, a little financial accounting. Is Ford going to do that? Or is it going to go the way of General Electric, whose payout ratio went up over 100%, and over 100% for how long, right? It went over 100% in 2016, and the stock held up through 2017. Didn't really start falling till the end of 2017. So we had about a year and a half here where the payout ratio was 100%. Right? It wasn't, it hits 100%, sell. But we weren't seeing GM stock get bought up with any sort of vigor or aggression. Then GM does what? They cut their dividend. They come out, they know it's not sustainable. They cut their dividend and the stock does. That's the risk. That's the risk with Ford. And when I look at Ford, I cannot say that $2 is out of the question. I don't think it goes to $2 a share. But if Ford sales trends continue lower and they're not able to increase those earnings, they may make that decision to simply cut the dividend. And if they do that, we're talking about a stock that probably goes to $3 or $2. Not that it deserves that much, but we'll see a significant overreaction there. We always do. And so while I think the chance of it doing that is very slim, right? I don't think it's a very high chance. That risk is there. And so if you're looking to go and invest in Ford right now and be a buyer of Ford, I think it's one where you have to look at that dividend as a very much bigger risk today than what it has been over the last years here for the stock. And I'd still rather own an AT&T dividend than a Ford dividend. And again, we've talked about AT&T, over and over. We talked about it all the time here in 2018 as far as a dividend play and all of that. But it probably needs a cool down period before buying again. But I'd rather sit on my cash, wait for AT&T to pull back, than go out and buy some Ford simply for the for the dividend there. As this market goes through, a pullback, right, which we're seeing, and it's very minor pullback right here, but as it goes through this pullback, you can go into different screeners and, pull up the dividend yields on companies. So we'll go and look at something over 5% for stocks on the S&P 500, right? And we now have 28 stocks on the S&P 500 with more than a 5% dividend yield. That's a big number, right? But there's some companies in here that have some pretty solid reputations. Some others in here that are retail. That there's a lot of fear that those dividends get slashed. There's an oil name in here, fear that it's going to get slashed. I can't look at this list and go, well, all right, this is a really solid company all the way around. Not a whole lot of risk here. It's eventually got to go back up. This is not something that's just going to go down and stay down. It's one where I think each and every one of these names on here have some significant risk parameters associated with them, with the higher dividend yield. Maybe Invesco a little bit better than others, but for the most part, we come to the second page of this. There's AT&T, right, which is still my favorite. But, we're getting into commercial real estate. We're getting into some of these Schlumbergers, the Exxon. I don't know that you want to buy Exxon for the dividend. And so, just one of those where we have not seen the dividends really perk up nicely for some of the better stocks that are out there. It has simply been for some of the some of the worst stocks out there, or some of the ones with more glaring issues, right? You look at a Caterpillar, the dividend yield on Caterpillar and what it's starting to do. I mean, the dividend yield here, let me pull it up. 3.3%. Okay, what is that historically for Caterpillar? Well, let's come in. Dividend yield historically for Caterpillar, right? It's one where when Caterpillar bottomed in 2016, the dividend yield was almost 5%, right? So, is 3% high for Caterpillar? Yeah, it's a high dividend for Caterpillar, but it's not this kind of, super high dividend where you just go, hey, this is kind of a no-brainer to be a buyer here. And again, that's kind of this, conundrum that money managers are in this market, because it's just some of the stuff, it's not quite oversold enough. The valuations aren't quite compelling enough, to be a big value buyer. But at the same time, are you going to miss upside if things, if the dominoes fall in a certain direction? It just kind of leaves that conundrum here. And I think Ford is a good example, Caterpillar a good example of that conundrum. But bottom line, from an investment standpoint, right? Investments are meant to be a little bit more conservative. I don't know that I'd really want to be an investor in Ford with that risk of $2 in play. And while that might only be a 20 to 25% risk, I don't think there's a really good way to quantify the risk. It's just one where, is it really all that worth it? You could go out and you could buy the stock to play for the dividends, right? And you could come into it and look at Ford and say, all right, well, great. I'm going to sit back. I'm going to collect the dividend. But let me go out and buy some put options to protect my position. Okay. Well, you know what? You go out and you buy the $7 puts for next year, right? You collect an 8% dividend off of 850 stock. You're paying more for your puts than what you're going to collect in the dividend and what the loss is going to be if, the protection is there. So it just doesn't make a lot of sense to play it that way as well. And so just one I kind of look at and say, next, and look for some other opportunities as they emerge, or wait for Ford to get into a fundamentally very cheap level. And then, if Ford's trading, what, $6, $7, right? If it's trading down near the lows from last year, and, some of the fundamentals are still strong, and we see some, glimpses of life economically. Yeah, okay, now maybe the risk is worth it, but up here around $8, $9, for me, it just simply isn't at this time. All right. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.